All right, we're back on the conversation on the TYT network. A lot of folks are asking, should I refinance these days in the middle of coronavirus because of interest rates? And specifically, should I refinance my student loans? We've got a guest on for you guys who is saying, no, don't do it, even though you might use this company to do it. So it's kind of an interesting situation. David Klein is the CEO and co-founder of Common Bond. They're one of the first online student loan lenders. David, welcome to TYT.
Thanks, Cenk. Good to be here.
All right, good to have you. I want to ask what Common Bond is in a second, but first, why not? Why not refinance your student loan now?
Sure. So it's a little more nuanced than that. We're advising people who hold a federal student loan that itself is held by the federal government. It makes sense to take advantage of the federal relief that's out there, which basically takes the payment to zero, takes interest rate to zero through September 30th. And what we're telling folks is, hey, take advantage of that and, be at the ready to start paying again come October 1st. And to the extent you want to transition from federal relief to refi relief on October 1st, then we have a platform that can really help you. And in fact, we've historically helped people save a lot of money on a monthly basis and over time by getting them into a lower interest rate loan, lower relative to what they're into the federal government. So if you're holding a federal loan that's held by the federal government, we're saying you might want to sit tight for a little bit, take advantage of relief. If, however, you have a federal loan that's not held by the federal government, and that's about 20% of loans, federal loans out there, generally loans that were originated before July 1st, 2010. Or if you have a private loan from a private bank or a private lender, it still very well could make a lot of sense to refinance your debt, especially with interest rates that are at historic lows.
What is the federal government saying now? Is it that you don't have to pay any interest on those student debts until October, you said?
Until October 1st, that's right.
Okay, got you. So obviously you don't want to refinance from 0%. That's a pretty good rate to get.
Exactly.
Yeah. And so do you have to make payments, though? It could be that your interest is 0% and you still have to make principal, or is that you don't have to make payments until October 1st?
It's both. So interest goes down to 0% and you don't need to make payments. The language says through September 30th. Now, what's interesting is that if people are able or so wish to continue paying their monthly payment every month, they can do so. And what's interesting about this time through September 30th is that every dollar that goes towards your student loan payment will go 100% towards principal. And so if you're able, this could be an opportunity to pay down your student debt faster, since 100% of everything that goes to pay down your student loan during this period through September 30th will go 100% towards principal.
And for those who choose not to pay it now, obviously because of economic hardship, do they add those months to the end of your, basically your loan?
Yes. So folks will and still owe the government the entirety of the principal balance that they received. But there is this moratorium on payment to help those who could benefit from some cash relief.
And so how about the private loans? Is there any break on the private loans, or nope, you got to make the payments? Yes, interest rates, if you refinance, are lower, but is there any relief there in any of the laws, or no?
There's something called forbearance, and forbearance essentially is a fancy word for payment pause. It's an opportunity for somebody who demonstrates economic hardship, whether because of COVID or any other reason, that enables them to pause their payments for X number of months at a time.
And is that just for student loans, or can people do forbearance on other things?
Generally, there's forbearance for other lending products as well. Certainly the case for student loans. And it's something that we've done for our borrowers since the very beginning. In fact, our standard forbearance program, from what we understand, is the longest amount of time, the most protection that exists in the industry.
How about mortgages? Are banks offering any forbearance or any accommodation for mortgages?
There is the notion of mortgage forbearance. Yes, that exists.
Okay, do you have a rough sense of how many of the banks are letting folks do that?
Generally speaking, that should be a relatively common opportunity for people with mortgages to get. Generally, the rules are very specific to each lender, to each servicer. And so what we say is, certainly in our industry, call your lender, call your servicer is the more appropriate and accurate way to say it. Call your servicer, ask them what your options are around forbearance. You should qualify for that forbearance. But of course, every servicer has their own set of criteria.
A lot of folks don't know that that's possible. My wife didn't even know that was possible. And so it's really important to get that word out. It doesn't mean that it's guaranteed or that it's definitely going to apply to you, but it's definitely worth asking.
For sure.
Yeah. So what does Common Bond do exactly?
Sure. So at Common Bond, we like to say, if you have a student loan, we can help. And we do that in 4 distinct ways. We have a platform we call Money Mentor Platform. It is human-powered, AI-assisted financial guidance, mostly for 17 and 18-year-olds, folks who are thinking about going to college, how to pay for college. We help people collect and secure free money like scholarships and grants. If they need financing, we have a low-cost financing option. So that's the first way we help people. The second way we help people is with in-school financing. So there are a lot of students who, in order to go to school, need financing, need loans. In order to do that, we provide low-cost loans for students to go to school. The third way we do that is through refinance, something you mentioned before. So this is for a student who has graduated, either an undergrad or a graduate program. They graduated with student debt, and they're looking to refinance that debt, consolidate it in one loan product at a lower interest rate, save money over time. That's what we do, and that's actually our largest business. And then our fourth business is for that student who graduated with student debt who's now gainfully employed. We have an enterprise business whereby we provide student loan benefits to employers that they in turn provide employees as a perk. And so an example of that is something we call student loan contribution. That's where we've built technology that enables an employer to contribute, say, $100 a month to their employees' student debt. People are calling it kind of the 401k of student loans.
What allows you to charge a lower interest rate than the rest of the market?
Sure. So the rest of the market is either the federal government or private banks. The federal government basically charges one rate to everybody. It's a little more complicated than that, but it's essentially one rate to everybody. There's no underwriting. So the government doesn't take into consideration ability to pay or willingness to repay a loan. They basically say, if you can prove you are enrolled at an institution, we, the federal government, will give you up to the total cost of attendance at that institution. What we do is we underwrite. So we take into consideration a number of factors. We're underwriting credit. We're looking at somebody's ability to repay and somebody's willingness to repay over time. And so because we do that, we're able to charge a lower rate than the one size fits all rate that the federal government charges. That's with respect to the federal government. With respect to private banks, frankly, we're branchless. We're 100% digital. So we don't have that cost in our cost basis. And so we're generally okay taking, frankly, less profit per loan than a big giant bank is. And so we're able to provide a rate that is a bit lower than the average rate charged by a lot of these big institutional private lenders.
Are there going to be retail banks in the future, or are they eventually going to go away because it's really easy to do it online? And why would you have all that expense of those retail banks?
Yeah, it's a question that's been asked for a while, especially with the advent of fintech. That being said, if you talk to a lot of the executives at many of the banks, I think you'll find I was going to say two camps, but there's really one primary camp. There's just gradations. The one primary camp is branches matter, but where there's gradation is how many branches you actually need, what the concentration of branches actually is. And there you run the gamut.
David Klein from Common Bond, and as he just told you guys, make sure you're looking into your options. This is a unique moment in time, and you might have more options than you realize. So thank you for joining us on the Young Turks. We appreciate it.
Thanks a lot.
On the go? Don't worry, we got you covered. You can still listen to TYT at our new podcast network. Find us on Apple Podcasts, the Google Play Store, or at tyt.com/podcasts.